Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
Mark, happy Friday. We've made it to the end of another week and the start of Digital Currents.
Happy Friday. And it's so humid in North Carolina. I feel like I have moved to Ireland. We set the all-time record for the most rain in August. We got another inch today. And so I'm fleeing to head up north for the football game. But so no long pants today, but I do have the orange shirt.
Oh, yeah.
You got the Carolina blue shirt. I like that. So the sock game is just here. I mean, I went old school. So if I were wearing socks, I would have these on, which are, people don't remember that the original Bitcoin logo was yellow. It only turned to orange in 2013 when BitBoy gave us the new one. So it's interesting, a little factoid. But look, we said couple weeks ago that we were worried about Rectember, but that we're still pretty, confident about October. But, our shape-shifting Fed chair, who we talked about last week, he kind of goes between steam and water and ice. And, you got Jerome the Hawk, you got, Jay the Dove, and then you got Jay the Pusher. And, he shape-shifted from Jerome back to J and cut rates bordering on the letter J. But the Chinese basically turned up the heat. And I think our illustrious Fed chair is going to shapeshift again into steam. I mean, he's just going to, poof. They cut the reserve rate. They injected a whole bunch, $114 billion of liquidity. Stock market, I mean, it's amazing. It's literally vertical. I mean, David Tepper, I retweeted his clip from a CNBC. It was great. They're like, so what are you buying in China? Well, I'm buying, Alibaba and this and these, and he says, but what else are you buying? Everything, like everything. And so, well, what if you're wrong? He says, this is the best. He says, well, what if you're wrong? What if it doesn't play out? He says, look, I put on a suit for y'all. I don't normally wear a suit. But the fact is, I don't care. That is the perfect edge. Now, as a Carolinian, I wish he would care a little more about football and, maybe step to the side and let someone. He's an amazing money manager. I mean, one of the best ever in the history of money management. But as a football owner, not so much. The Panthers stink.
So. Yeah, and I think sports are always that one avenue that is kind of the elite club. You're always trying to get into. People are very much long-term thinking generally, except for Mark Cuban, right? Mark Cuban had a very nice exit. He came in and obviously has some overtures into our side of the house on the VC side. But I'm sure that you've seen, like, within this market now, Mark, we're starting to see, as you kind of opened up with this idea that September was a little bit rocky. October kind of had some more glimmers of we're starting to see things a little bit earlier now. So kind of with this week driven by these rate hikes, and there was a word as on the tip of my tongue, and it relates back to your days as a budding biologist and chemist, sublimation, when you go from the solid state over to the gas state, right? Is that
awesome? Right? Sublimation. Exactly. He is about to sublimate, and rate cuts. You slipped with the rate hikes. No, it's all about rate cuts.
That's right. Rate cuts.
They're cutting rates with abandon. And look, the economic data is supportive, except for the made up labor numbers, which are completely made up and fabricated by this BLS. I say they should lose the L. It's the Bureau BS and this birth death ratio. But LEI are cratering. business confidence cratering, PMIs cratering. Now, it's not like we're going into a depression, but recessions tend to lead to downturns, and therefore liquidity gets turned up, and you can create sublimation with enough heat. The other thing that I think is interesting here is what's happening with accounting. Now, there's this guy, John Kenneth Galbraith, who back at the turn of the century coined a term, the bezel, which is kind of where embezzlement comes from. And he said the bezel, which is the amount that's stolen by the operators, by the business owners, by the accountants working for the business owners, always exists. But as you get away with it, you take a little more, and the bezel starts to rise. Well, then it gets to a point where someone says, no, this is just too much, and there's a busting, and then the bezel falls. Markets fall, everything collapses, and then it starts over. So the bezel rises, then collapses, then rises, then collapses. Well, the bezel, the non-GAAP accounting adjustments, set a new all-time record, like worse than 2000. And what people forget is in 2000, Cisco had this little deal with Nortel where they were supposedly selling all this stuff, and both stocks literally went parabolic. I mean, parabolic. Intel's too, because they were going to, save AI. I shouldn't say save AI. They were going to create AI, which didn't work out very well. But long story short, it turned out that there was a whole bunch of fake stuff. They weren't doing the switches, and the switches they were selling multiple times and accounting for it. Well, there had to be a big accounting adjustment, and everything went down, and the stock market went down 55%. Some stocks went down 98%, like Sun Microsystems, et cetera. It turned out that the ebullience wasn't real. Well, yesterday it was announced that SMCI, Supermicro Computer, third largest customer of NVIDIA, perhaps was cooking the books. Let's just say it for what it is. Stock went down 20%, and I'll be on record. This is the beginning, and there's going to be a whole bunch of did you mean we needed to account according to GAAP? And there'd be massive adjustments. And I'm not saying NVIDIA is going to go down 98%, but some of these stocks could go down a lot, just a lot.
No, it's funny that you mentioned that. I think kind of the point I wanted to kind of jump to on the Bitcoin side is that sort of the rate drops, not hikes, kind of prompted a little bit of this growth, because we're seeing kind of these new renewed interests. But we're getting close to the 65 mark. I think we just hit it, and there's this idea now that 70 will be the new threshold. But there was sort of something that we've been paying attention to, and have been speaking about, this sort of this trading pattern that happens with ETFs, and how basically we're using this as an options play. So some of the inflows aren't really representative of market demand and strength. But Mark, I want to get your thoughts on this, because now recently, as you've just seen, approval for an options product out of NASDAQ from the SEC just hit the news. Now it's limited, I think, to like 25,000 contracts, something like that. So it's not going to be a wide limit here. So it's very conservative. It's very unusual for this to get done. But Mark, I think this is sort of
super bullish.
Yeah,
super bullish. No, it's super bullish. And well, why do you say that? The futures aren't bullish. Well, no, the futures are not bullish. Futures enable you to create a commodity out of thin air and create a paper version, which means you can naked short a paper good, and you can put downward pressure on price. Options, just the opposite. Options allow for, you can write options and get on the wrong side and cause problems. But But the bottom line is options are bought by speculators. Now, the problem with options, 85% of them expire worthless. It's an amazing statistic. So I would say if you ever have an urge to buy a call option, just buy a put. Just do the opposite. If you ever have an urge to buy a put option, just buy a call, because you're going to be wrong 85% of the time. And so writing options, super, super profitable. So Ken Griffin, one of his biggest, profit-making things is he's the largest options market maker, and he just writes and takes a fee for options exchange. And the S&P, as more and more money came in and it increased the flow of the passive, more and more options trading happened. And that options trading puts additional upward pressure because people are just speculating on the price. And so, yeah, I think it's going to be big. And the other piece that, again, doesn't get enough airplay is the supply and demand change that just occurred, in that we talked about this. There's been this distribution pattern since February. You had the euphoria in February from 44 to 74, almost overnight. And then since 74, we've been making this series of lower highs and lower lows. What are you talking about? Well, that is a distributive pattern, meaning the people who own the coins already are distributing to the people who think that the price is going to go up. So this week, a new higher high for the first time in 6 months. And we didn't make a new lower low. And on top of that, we made maybe one of the most beautiful inverse head and shoulders. So there's a pattern where you make a shoulder, and then you make the head, and then you make another shoulder. And this neckline, right? If you break through that, that's negative. Well, if you turn me upside down on my head and you have a shoulder and then a dip and then a shoulder, well, if you break through, it's also referred to as a cup and handle pattern.
Yeah. I used to think about it as the Bart Simpson curve, where you got down and then the up and then the...
Exactly. And there's so many of these interesting patterns that heat. And why did they repeat people? Oh, this is voodoo. It's not voodoo. It's humans. Humans are going to human. Humans buy what they wish they would have bought. They sell what they are about to need. They do things over and over. They chase momentum. They don't buy value. And look, investing is the only business where things go on sale, people run out of the store. And the cheaper the price, the further they run. Like, what other business? You put something on sale, people beat each other with, shopping bags to get inside. But
We've
not
all seen Black Friday videos.
Black Friday videos, exactly. My favorite, the Schwarzenegger movie.
Oh yeah, Jingle All the Way. That is a holiday classic.
Jingle All the Way, baby. It's hilarious. It's hilarious.
But what say you, Mark, though, that the idea with options, I've seen a couple posts on X about this, and I'm not 100% convinced, but I can see some logic here in that it could create more leverage opportunities with some of the options trading. And then, of course, you have the doomsday scenario where it could destroy the economy.
No. Look, it's, again, really important. Options are a tool for leverage. Same with futures. Yeah. Anything where you don't have to be fully collateralized, meaning dollar for dollar, you have the potential for leverage. Leverage is not bad in and of itself, right? Leverage is an amazing invention. It's a way of recirculating capital that would otherwise be fallow and latent. So leverage is a good thing. And I know all the, fractional reserve banks, oh, that's evil. I mean, it's actually one of the greatest inventions of all time. But like everything, there's a point at which the marginal utility or the additional unit of benefit can turn negative. And so, normal options about 10 to 1 leverage. And that's high. And for many assets, it's not a good idea, which is why most options expire worthless, because 10 times leverage, you need single-digit volatility to kind of make that work where you're not going to, end up bust. Problem is some of these programs will then give you a leverage on the options so you can get to 20 or 30 or 50 or 100 times leverage. I mean, that's what futures, you can put 1% down in some futures markets and get 120. You can trade treasury futures with 1% down. Commodities is usually around 3%, so 30 times leverage. Look, if a commodity price doesn't change very often, think about your house. Most people have 4-to-1 leverage on their house. 80% mortgage, 20% down. A lot of people, 3% down. So you're talking 33 times levered. My little brother, 1% down. That's 100 times levered. Well, you don't mark to market your house every day. Right? So you don't feel the pain. Now, if you got transferred somewhere and you decided you had to move, now that doesn't happen as often anymore, but let's say you had to move and you had to sell the house. Now you're going to realize the pain. And the problem is, if you're 100-to-1 levered, 1%, you've lost all your equity.
Right.
Whoa. If the price goes down 1%, I lost all my equity? 100% of my equity? Yeah, that's right. Whereas if you had no leverage, go down 1%, you lose 1%. If you got 50% leverage, go down 1%, you lose 2%. So that's a long answer to say options are not bad. Leverage is not bad. Leverage used appropriately. Now, leverage on an 80 vol asset, less good. And it's why I will predict the vast majority of options on Bitcoin will expire worthless. And the people who write those options will make a lot of money.
So then I think, what this has meant, as we've seen some of these other signals, is this week we've seen a new record, or second consecutive week of inflows, over 321 million after the Fed's decision to cut rates. Most of those were on BTC, but this was an interesting kind of thing that I couldn't really wrap my head around, is that on the Ethereum side, we've seen continued outflows. But this week, we saw better performance relative to BTC on their growth. Now, they had been doing, let's be clear, way worse than Bitcoin over the last 6 months post-approval. But this particular week, they're up something like 18%. BTC was up like 7.5% around Monday. But you're not really seeing those inflows come in, except for our friends at Bitwise. They had an instrument where we saw some inflows. So that was good to see. But I'm kind of curious, especially on the Grayscale side, just really the ETH product has not really taken off. And I'm wondering if it's as simple as there are other altcoins out there. So if I'm let's say DGen or Web3 native, I'm not looking at ETH because I've got so many layer 2s to play with if I need like a tech stack. And then if I'm an institutional guy, I'm thinking Bitcoin and I'm not taking the risk of these assets. So what are your thoughts, Mark?
No, I think you summed it up exactly right, X. I think ETFs, for ETF's sake, don't really make that much sense to me in a world of bearer assets.
Yeah.
So particularly the average DGen, they don't need the ETF. They're buying these assets on their wallet or their Coinbase account or their Kraken account or their Binance account or their Ledger. They're actually buying directly and holding directly. So they don't need what I call the boomer wrapper, right? The boomer wrapper is perfectly fine for my dad, my uncle, my friends. I'm going to see all my classmates from the class of 85 this weekend. We have the badass class tailgater. I love who came up with that name. And I'm going to be a bunch of 61-year-old guys and gals sitting around reminiscing about glory days. But more importantly, most of them shouldn't fumble with ledger devices and keys, and they just buy the ETF. And totally fine. They've already got the Schwab account. They've already got the Fidelity account. They've already got the Morgan Stanley account. And I still can't buy it at UBS. Come on, UBS. Come on. Crazy. But at the end of the day, the problem I see for ETH is all the other L1s that are faster and cheaper are causing, you know, they're shiny, right? It's the, it's like the dog with the squirrel butterfly. And so everyone's over here talking about Solana. Now the new one, I just saw they're doing a big thing on SWE. And, SWE came out and it went like this. And now it's kind of going like this, like, hey, whoa. It's better, it's faster, it's cheaper. Pick two. Can't be better, faster, and cheaper. You can be faster and cheaper. You might not be better. But long story short is they launched a ETF around SWE, and they're like, please buy it. Well, maybe they'll get some interest. But if you want to own, to your point, the institutions want to own digital gold. They don't care about smart contracts. I mean, maybe they will someday. But right now, they just, hey, you tell me it's digital gold. You tell me Druckenmiller's got it. You tell me, other nation states are thinking about buying it. El Salvador's got some. Okay, I'm going to put a little bit, just a little bit. They don't want to deal with the hassle of it. It was kind of like, I don't remember, Kyle Bass was on the board of one of the techs, I think it was Utimco, and he was convincing everybody back then, this is 15 years ago, to buy gold, right? And he has this vault in his office, got this big stack of gold bars and bricks, and they're like, well, okay, so we're going to buy the gold. So what do you? Oh, well, you got to buy it, and you got to put it in this vault, and you got to hire security, and you got to have these special forces. Seems like a really big hassle, but necessary, right? You can't have gold bricks just lying around in the cupboard, so you gotta secure them. Bitcoin's different, right? It's more portable, it's more divisible. We can have it in Zappo in cold storage, off the grid. Now they have armed guards and they have security cameras, kind of like a Swiss bank vault, just for appearances. But anyway, I do think ETH it's either fish nor fowl. It's kind of stuck in the middle. It's not new and shiny. It's not Bitcoin, and it's not money. I know, the bankless guys are like, it is money. Like, no, it's not. Money is an asset that exists in the absence of liability, and it needs proof of work. In my mind, when you convert energy into value and verified by work, that is what gold, right? You dig it out of the ground and you store it, you smelt it. Same thing with Bitcoin. You don't dig it out of the ground, but you do work and you prove value by converting energy to value. And, just saying, well, I have a lot of it, therefore it has value. Not really. So smart contracts are good. Don't get me wrong. I got lots of time for smart contracts, but proof of work to me is the ultimate store of value.
Yeah, I think probably a quick one before we transition into AI is our friends over at PayPal. They've expanded the cryptocurrency capabilities to business. For me, I think this is sort of it's an interesting story, but for me, it's not that significant because I bought some crypto on Venmo, which PayPal owns a long time ago. It's actually great. I was playing golf with a buddy in the virtual simulator. Everybody's better in the simulator. So we had a golf bet, right?
100%.
And so it was like, $100 or whatever. Ended up with the win, put it into Bitcoin, and that golf bet has been much better than the original $100. Thank you, Venmo. But now PayPal's been his customers.
Well, that's one of the best things about things that are difficult to use. You just don't use them. And I've thrown this stat out before, right? The best performing accounts at Fidelity are the deceased and inactive.
Right.
Because they don't do the things that humans do, and they just let this thing go. And so, I have a bunch of wallets around that I was trying stuff out. And to your point, they all just keep accreting. I mean, there's volatility intra-period, but they just keep accreting, which that's kind of a good thing.
So there's one company, Mark, that we don't talk about a lot, at least not in a positive way, but nonetheless, we talk about Salesforce. Okay, so Salesforce is a company that everybody uses that's got some sort of an organization, more than 5 people, and have in sales. So what's interesting with this company is, there were legacy roots out of Oracle. There's the shift towards the cloud. And, Ben Hoff kind of is the figurehead for this sort of cloud revolution, fair or unfair.
Yep.
And so lately they've been on a buying spree. So as we've been saying, that there is going to be this mass exodus for AI M&A, and they've added another company to their stack. So Zoomin is a company that's out of Israel. They were bought recently for $450 million bucks. This is an up round, or I guess up from their last round. And basically what they're going to be helping Salesforce with is some of the Gen AI stuff, actually areas that we've invested in, Mark. And I think so much of this is timing and having the right partner. So Salesforce had invested in Zoomin earlier when they were a kind of a seed stage company, and then eventually, bought them into the fold. They take unstructured data, a lot of messy things, and this is perfect because everybody's Salesforce is usually a mess because people label things differently, and they structure this and make it much more indexable and searchable, and eventually able to use Gen AI to be able to do queries on this in a normal way. And previously in the summer, Salesforce acquired another company for a lot more than this. There was a company for about 1.2 billion owned that was also based out of Israel. So this is something that I'm seeing as a trend that nobody's really talking about Salesforce as this AI power, but maybe we should be thinking about them a little bit more because they keep making
come on, you know I'm not a Benioff fan, and the guy, well, he's way smarter than me, right? He is a master salesman.
Yeah,
he goes on television once a quarter, right after earnings, tells everybody why. Yeah, the numbers weren't exactly what everybody wanted, but here's why they're really, really good. And he's convinced everybody. And look, at the end of the day, it's pretty basic, software. It's a database to keep contacts. Okay, great. But look, he's no dummy. I said the best sales call, quarterly earnings call the last year has been AI. I'm just going to say AI over and over and over. And the more times I say AI, the higher my stock price goes. So, they've even got commercials with AI. I'm like, okay, what AI do I need? Are you going to generate magical new leads out of thin air, Mark? My leads are my leads, and my people are my people. You can't fill up my database with new fake people that maybe, people got their digital girlfriend or boyfriend. No, that's that. So I don't really get it. Okay, are you going to use an LLM to write sales call emails instead of a human? Fine, but I don't need you to do that. I got, and I do want to give a shout out to ChatGPT, right? I was very skeptical at the beginning. It was horrible experience. It was always wrong. It was hallucinating. I do find I'm now using it every day because I think they changed. In the beginning, they were what they said they were going to be, right? Which was this generative tool that was going to intuit based on, the last word, what the next word is, and it was creating these sentences. And the problem is, if it didn't know the answer, it would just hallucinate. That wasn't very useful. To me, what they are now is what Google was 15 years ago.
Yeah.
They've indexed the internet, and now they just point me to the place where I need to go without ads. Google is unusable. I'm never searching Google anymore. Never. Not ever. Because it's just unusable. It feeds me stuff that's not useful and is paid for. Whereas when I ask ChatGPT, now it doesn't give me some fancy answer. It actually says, okay, here's the data you're looking for. Now, it's still wrong sometimes. I was telling this, I don't know if I told this last week, but I was with one of our portfolio companies, and we asked, who are the world's leading experts in semiconductor design? And it listed the first two. The third one, the guy I was with said, I know him. No, not even close. And that's the way it is. Other people were saying those first two, I know him. And the first one, Jihan, as ASICs go, and I don't know if Jihan was the engineer, right, at Bitmain, but somebody was. It was probably the second one that was listed. I can't remember his name, but he left and did WhatsMiner. So, but the third one was this Israeli entrepreneur, and they're like, no, he is not. I mean, he's a smart guy and he's good, but he's not like, world's foremost authority on ASIC design. So ultimately, indexation is super valuable because the idea of searching the vast world of the internet and all the garbage, and I don't mean garbage in the negative sense. It's just, there's a lot of stuff that's garbage for what I want, right? I don't need to know about baseball if I'm searching for football. I don't need to know about cricket. Not that cricket's not good, but going to where I'm in, and football, there's two footballs. There's football and football. And so going to the right football to get information makes sense. And I don't need you to intuit what you think I mean by football. Just give me the stats. So, but again, here's the problem. Google is useless because they make a lot of money. Because they sell all those premium spots for my eyeballs. They don't give a crap of whether they return what I need. The problem for ChatGPT, they do all this fancy calculation to go get the actually pretty good data, but they're not getting paid. I'm not paying for it. I'm not paying them. There are no ads, so they're not getting paid. And so I love this, OpenAI now wants to convert from a not-profit to a for-profit.
Yeah.
And grant Sam 7%.
Yeah.
Whoa, time out. And at least Elon is calling BS on this. That's wrong on so many levels. But more importantly, how are you going to become for-profit if you lose money on every query? Every single one. Oh, well, you can start charging me for my query. You're going to turn into Google and be useless? Then I got to go find another tool.
Yeah, it's funny that you mentioned that, Marcus. That was exactly one of the next points to talk about, is that this is going to be the next chapter from this summer. We saw that there was the coup where Altman left ChatGPT for a brief while, was going to be replaced. He managed to sort of get the votes to come back in there. And as part of this, there's going to be a different board shift, transferring control away from the nonprofit stuff to more investor friendly. This is going to be an epic movie when it comes out. So now he's going to be granted new shares, which could be worth billions, of course, as the company is valued over 150 billion now, arguably more than that, given its importance within Microsoft. But there are a lot of concerns with this. Obviously, one is sort of the ethical side, which talks about the origination of creating safe AGI. And so safety is this big issue now because we're seeing the FTC making a lot of crackdowns on deceptive AI claims. So first, it's companies that are saying that they're AI and they're not doing exactly what they're supposed to do. So companies like Writer and Do Not Pay, they settled agreements. But I love this. They settled agreements, Mark, but then they admitted no wrongdoing.
I love it. How does that I don't understand. Right? How do you pay a fine? In many cases, big money, like hundreds of millions or even billions of dollars, but not admitting guilt. Isn't the act of paying the fine an admission of guilt? And so you can tell me you're not guilty. I mean, it's literally like P. Daddy saying, or P. Diddy, whatever his name is, saying I'm not guilty. Like, well, there's a whole bunch of evidence that says you're guilty of something. And I don't know if it's all propaganda and I don't know if it's smokescreen, but it looks like he's pretty guilty of some bad stuff. And so he can say I'm not guilty, but I don't know.
Yeah, I mean, there was a whole movement about this, right, that led to the Catholic Reformation. It's called selling indulgences, right? So that was supposed to be something that was...
Amen.
And, I mean, I think we should definitely find an episode where we can go down the Diddy rabbit hole. But, one thing that was probably worth getting into is, on the regulatory side, thinking about Dubai. We're getting ready to go on another trip in a couple of weeks. And so that market is an interesting one, both for AI and for crypto. So they've got the VARA, the Virtual Assets Regulatory Authority. And so starting next month, October 1st, crypto companies in Dubai, they're going to be required to display risk disclaimers warning customers about the extreme volatility of the virtual assets. So, Mark, I think that this is a little bit of a much to do about nothing. Maybe like those EULAs and the start of every single app where you have to click and accept, a bunch of pages that nobody reads. But nonetheless, lawyers are.
Look, I mean, I don't really understand, other than it's in the incumbency effect.
Sure.
Right? The incumbents that are being disrupted, the only way they can fight back, because they can't beat the technology. The technology is superior. So the only way you can fight back is through regulatory pain and try to make it hard for people to beat you at your own game. And so here's the thing. Where are the disclaimers for the triple levered, ETFs that go down 99.99999%, right? I mean, literally wipe out billions of dollars. Anyone can buy those. No problem. But you can't buy a Bitcoin ETF that doesn't have even a fraction of the volatility of those stupid things. Where are the disclaimers on micro cap stocks, right? Which again have way more pump and dumpiness than the top cryptos. Maybe the bottom meme coins and stuff, those are pumpy and dumpy, fine. But at the tippy top, So, but there's no disclaimers because that's the incumbency effect. Now, there used to be, right, if you go back to the turn of the century, there used to be big warning labels about, hey, stocks are risky and these, boiler rooms are bad places, and they used to pass out pamphlets saying you should avoid, these things. But again, that was because the people at the top were paying people to make you think that these things threatening them were bad. So I keep coming back to what is all of this technology, like what is AI really doing? Well, AI is a tool set, and it's a tool set to make better decisions with data. When we talk about the ABCDs, right, our mantra for our investment strategy and for the show, ABCDs, AI, blockchain, chips, or computing platforms and data. Well, at the end of the day, we go backwards, right? It's data, which is the layer, and, your old cohort, Larry Ellison. I guess we're having flash flooding here in Chapel Hill. So I don't know how to I can't turn that off, right? There we go.
That's such a great segue, because I'm sure you saw this probably final story is about AI and IBM and NASA. So IBM is trying to continue itself to be relevant. They're also the owner of the weather company. So they partnered with NASA for a new AI model for advanced weather and climate applications. So clearly this is just a sign that's meant to be. And so this is going to be a code name Perth V WXC, which just rolls right off the tongue. Terrible name. It's an open source model now available on Hugging Face, which we know well. And basically it looks at like the short-term and long-term climate predictions. It's got 2.3 billion parameters trained on 40 years of NASA data. So I think, we're living in a world, especially where extreme weather is becoming more and more common. We're going to need more and more models and predictions. And I think people ask, hey, what's a practical application of AI? Easy answer, weather forecast and model.
Oh, absolutely. And although, would it have forecast that Hurricane Helene would become a Category 4 on the same day as Hurricane Helene in 1958? September 26th, although Wikipedia changed it to the 27th, which I thought was weird. Why would someone change that date? But anyway, random coincidence. But I do think it is interesting when we think about all of the applications of, all this data, tons and tons and tons of data. I say 40 years of data. There's probably some patterns in there that we can utilize if we have, one, chips that can process that much data quickly. So, we need the Moore's law kind of processing power increase. Well, we also need to store that data effectively and in open source world, what blockchains do, right? Which makes a lot of sense. So people can use it and not have to pay somebody to use their data for public utility type data. And then there's the AIs that are going to be decision rules or decision tools that, I'm sitting here, I'm going to get on an airplane a little bit later, hopefully, if they keep the airport open. And it's so funny. We're going to get 1 inch of rain. Now, granted, it's an inch. It's like that wafer thin mint from that old movie that no one watched. But we just set the record all-time rainiest in North Carolina, and we're going to another inch today. But yeah, we got national weather alerts because of an inch of rain. Okay, I mean it's an inch of rain, but it's not the end of the world. And normally I'd be flying on Southwest on a day like this because they fly through anything. Those pilots are unbelievable. But I decided to be cheap and I use my miles so I'm flying American. So hopefully they don't do what Americans good at. Oh, we got a maintenance problem. I'm like, no, you don't. It's perfectly fine out there. So
we'll try to get you out here quickly, Mark, and jump into the chart of the week. Let me know if you can see the screen. I will share. And so this chart kind of brings us back to the initial conversations we had on the Fed. And what this is zooming in on, Mark, is the impact of middle market private equity, and specifically how it's outperforming mega cap private equity, in particular, how it impacts its performance in different interest rate environments. And so what I think is particularly interesting about this, and they're defining middle market as 100 million up to 5 billion. And the idea is that it will mid-market will outperform mega cap by over 500 basis points on average in this period when you're, seeing some of these declines on rates. And I think what's the idea here is that on the mid-market, it has to kind of stand up on its own merits. So it's less dependent on things like leverage. When you get super big, you could just sort of start borrowing, making some capital improvements. I think we always kind of keep an eye on what private equity is doing as VCs. We kind of swim in similar waters, although kind of we're at different stages. But I think some of those lines, Mark, are getting blurred. At least they are for me when we start thinking about some of the investments, in particular in the later stage stuff. We see some of those firms jump into our deal, sometimes in Series B. I mean, Mark, you must have an opinion about some of these funds as they relate to interest rate environments. Big funds versus mid funds. What are some of your thoughts on?
Look, size is the enemy of performance and alpha, and it's always been the case. And look, when you're small, you can be nimble. You got low cost base. You can enter a new market. You can make exorbitant profits. But then the competitors come, right? If you innovate something, you have a window of time where you can make really big profits. But then the competitors come, and then what happens is the big companies buy up all the smaller companies to fill out, it's like, pharma companies buying biotech companies. The problem is everyone says, well, there can be all these synergies. For cutting jobs.
Most expensive word in the dictionary, synergy.
Exactly, most expensive. But they never actually pan out. And so 70% of what we allocated to was funds 1, 2, and 3. Why? Because smaller is better. And this data that you're showing proves that out. Now, there's another reason. You mentioned this really important point. In buyouts in particular, the middle market and small market is less efficient, right? There's less capital chasing fewer deals, and it's more founder-based and small businesses. And to your point, they have to make money. And so they tend to grow. Now, when money becomes free, all these big companies lever up and they pay out big distributions to the private equity firms. And those funds do nicely as long as debt is cheap. So when we had a ZIRP interest rate policy, which some would argue was engineered so those people could get super rich, it all breaks down. And the normal, venture capital and growth equity and small buyouts, they lag the big fancy, KKRs and Blackstones and et cetera. Well, now we're back to normal, rates normalized. And what we're seeing is that things are happening. And the thing that we get so excited about is when you go one level down below this growth equity buyout space, and you talk about venture, 21, 22, those, let's just say vintages are going to be kind of stinky. Is that a technical term? Well, why? There was way too much capital chasing too few deals, and people overpaid for everything because they just wanted to be in that deal. It was a hot deal. Oh my gosh, got to get in. Well, then we have the downturn in markets, 22 collapse in markets, and then everybody starts laying people off and all these tech layoffs happen. And now we have this incredibly good thing. IPO window down. You showed the chart a couple weeks ago, down 95%. IPO down 95%. M&A activity down 85%. So suddenly you got too little capital chasing lots and lots of startups. And then on top of it, we have this innovation wave, this 2024 innovation wave, the 58 and 54, 68, 82, 96, 2010, 2024 tech cycle. You put all this together, it's a very, very powerful cocktail. I do think small buyouts are going to continue to do well. I do think the big stuff, those synergies are not going to materialize as they never do. And then as we talked about earlier today, when they start making people actually do real accounting, all that fake accounting stuff is going to cause, I think, some of these very, very large things to get revalued. So focus on the small, focus on the repeatable, focus on the businesses that actually make some money, and focus on innovation as an asset class. And that's what the ABCD is all about.
Yeah, I love that, Mark. And that's probably a good way to conclude. And a reminder to, the investors listening out there, just because there's a brand name and it's a big size fund does not mean that you're getting optimal performance. A lot of times you're seeing some managers that are at just a level below, just for AUM or whatever. Pay attention to the strategy, as Mark was saying, pay attention to the fundamentals. And that's really what we should be focusing on. And of course, we'll always remind our listeners, rate, review, and subscribe. Tune in on YouTube. See if we're matching. See what the soft game looks like, what the reveal is. And we'll remind our listeners, as always, to stay current.
Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.